Hey guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is Wednesday, it is January the 12th, and it's about 9 p.m. And what we are going to do today is take a look at some of the big kahunas in the pipe business. So this is one of those examples of he who has the biggest pipe wins. So we're going to talk about some of the largest pipeline midstream guys. I want to say in North America, but specifically I should say in the United States and Canada. So we're going to talk about these midstream players. And if you're wondering what midstream is, well, midstream is kind of in the middle, or in midstream between upstream and downstream, right? So the upstream guys are drilling and producing, and the midstream guys are responsible for transportation and treatment. In addition to the refinery business, they have pipes. They move the stuff that we consume on an ongoing basis. Specifically, what I'm going to do is look at 5 of the largest pipeline players in the United States and Canada. And Enbridge is by far the largest of these 5. And then we're going to look at Enterprise Products Partners, so EPD. TRP is TC Energy Corporation, which until just a few years ago was actually called TransCanada. And KMI is Kinder Morgan, and ET is Energy Transfer. Now, if you've been following my channel, you will know that I am long on a couple of these, so I don't need to bore you by telling you which ones they are. You can see all of them are pretty much in the oil production and pipeline business. The outlier here, a little different, is TC Energy. So just for what it's worth, TC, or TransCanada, is the company that was responsible for the Keystone XL. Now, in case you think that with a stroke of the pen, President Trump approved the Keystone XL, and with a stroke of the pen, President Biden canceled the Keystone XL, that would be correct. However, what you need to know is that the Keystone pipeline has been in existence for quite a number of years, and the XL was actually just a shortcut, effectively cutting the sort of 90-degree angle, if I could put it that way, where the pipe was carrying a variety of different oils and gases from the Canadian very rich tar sands in Alberta, across Saskatchewan, and then sort of south down to Texas. Now, if you sort of imagine that as a proverbial sort of 90-degree angle, depending on which way your map works. So from Alberta to Saskatchewan and then down to Texas, the XL was actually going to just cut across that sort of 90-degree angle. So by canceling the Keystone XL, both the presidents that approved it and canceled it effectively just canceled the shortcut, not the actual pipeline. So let's take a look at the technical. So in case you lose track of me, right here at the bottom, I put the logos in. So Enbridge, EPD, TC, TRC, actually, TransCanada, Kinder Morgan, and Enterprise Transfer in that same sequence on every slide. Stochastic, what does this mean? Now, here's the thing, guys. So traders always say if the stochastic is greater than 80, it's overbought. In other words, stay away. If it's below 20, it's oversold. I have said this before myself, and you know, the more I look at it and the more I investigate this, I'm not really a technical guy, the more I realize that this is actually not correct. It's not true. It's not a good benchmark or criteria to base a stock entry decision on. Stochastic score on its own is certainly worth looking at, but it's not something that one should base a decision on. What the traders mean is that an oversold market has a high chance of going down and vice versa. That is absolutely not true. I've looked at a number of stocks where the stochastic was greater than 80, and look at all 5 of these, greater than 80. According to the stochastic score, these are all overbought and you shouldn't buy them. I beg to differ. Weighted alpha, down here at the bottom, I explained weighted alpha shows that the security produced a return greater than the benchmark. And you can see the alpha here is positive, and it is significantly greater than the benchmark. And a couple of them, like Enbridge and Energy Transfer, did exceptionally well from a weighted alpha point of view, which once again is just another single benchmark or metric. So let's take a look at this though. If you look at the performance over the past 5 days, you know, if you take a real short-term view, you can see they've all done pretty good. If you go back a little further, you say over 3 months, how have they done? And interestingly enough, only EPD was marginally and slightly positive during the past 3-month period, or 3 months ago. And over 6 months, you can see that there are a couple of them that have performed okay. None of them have done particularly well. And, I had a conversation about this with 2 Cent Oil Baron on Twitter. And I said, right now, the Midstream guys are not really my favorites. It's not because I dislike them, because I don't want to be buying them. As I said at the start, I'm actually long in 2 of these, might even add a 3rd. It's just that I don't like them right now because of the way that they're performing. I don't like bad performing stocks. I want good stuff in my portfolio. Let's take a look at this market cap. And what I've highlighted here for you is just purely an indication of size, right? So in the same sequence again, Enbridge is by far the biggest, $83 billion market cap, all the way down to the smallest one, which is Energy Transfer at about $30 billion. So what else am I highlighting here for you? This one, annual sales, almost $39 billion. Okay, guys, take a look at this one. So Energy Transfer's annual sales is about $39 billion. Its market cap is only $29 billion. How does it compare with the others? Well, Enbridge has a market cap of $83 billion and sales of $29. EPD, $52 and sales of $27. TransCanada, or TRC, $49. Market cap, annual sales, less than $10 billion. See what I'm doing here? I'm showing you the market cap of Energy Transfer. The market cap of the entire corporation, or the entire limited partnership, is significantly below its annual sales. Just for the last quarter, Energy Transfer generated sales of over $16 billion, which is more than 50% of its market cap in just 1 quarter. How about the 60-month beta? If you have a beta of greater than 1, it suggests the stock is more volatile than the broader market. So there's a reason why I have Enbridge as a foundational stock. It's not very volatile. It's just steady Eddie. It just kind of tickers along, does whatever it does. It's I hold Enbridge for the same reason that Warren Buffett, for instance, holds Coca-Cola. I don't expect it to make me rich, but I park money in it, and I get a very, very good dividend. And that dividend is paid out for me quarterly. And currently it yields approximately 6 to 7% on an annualized basis. So Enbridge is, for me, almost like a savings account, right? And then the beta over here, you can see by far, ET was the highest, over 2. And a beta greater than 1 suggests the stock is more volatile than the broader market. So you can see ET by far is the most volatile. I don't have a problem with volatility. In fact, I like a bit of volatility because it gives me lots of buying opportunities to add some more to my existing long positions in a particular stock, assuming that the fundamentals are good. Because if the fundamentals are not good, I do not want to be adding any more of that particular stock. And right at the bottom of the page here, you can see the price earnings ratio of these 5 stocks. Now, I've said on many, many occasions before, if it's sort of below 15 as an average, I'm immediately interested. And if it's above 15, like Enbridge is, I'd be less interested in adding to my position at this time. You can see EPD is not, not too bad at 11. Energy Transfer has a price earnings ratio for the past trailing 12 months of only 5. So it is super cheap, assuming, of course, that fundamentally it's sound. How have they done over the last year? So this is a 1-year graph in terms of performance. And you can see over here that even my old stodgy, steady Eddie Enbridge has actually outperformed 3 of these. And the only outlier is this green line at the top here, which is Energy Transfer. Now it's kind of like trying to get back to where it was a while ago, because it took a huge dive here. Of course, it was much higher than the rest of the market. If you consider or compare it to its peers, it was outperforming significantly, only to come tumbling down, but still finished on a 1-year trading basis, significantly outperforming the others. You got 3 over here in the sort of teens to high teens. You got ET at about 37 and EPD at 5%. So the question is EPD a buy? So let's go a little deeper on Enterprise. And I'm going to do a quick snapshot here. I'm actually not going to go into the balance sheet or the income statement or the cash flow analysis for EPD. I'm actually just doing a quick over sort of 50,000 foot view here of enterprise, and we see how we're doing. There's a little bit of run rate here. You'll see the current stock price is $24, and just a short while ago, it was actually trading at about $25.69. It's not a small company by any means. It's got a market cap of 52 billion. The price earnings ratio, as I mentioned a minute ago, looks pretty good. This is on a trailing 12-month basis based on GAAP accounting. And the annual dividend yield is very lucrative, $1.86. And based on the current share price, that is yielding almost 8%. So if you're a dividend investor or you're looking for somewhere to park money, EPD don't look too bad. How about the profitability analysis? Well, this is an interesting one for me because usually you find that companies that are outperforming on a gross margin point of view generally tend to sort of over or outperform their peers when it comes to operating profit or net profit. This is an interesting little picture here because EPD is actually underperforming the industry and quite significantly when it comes to gross profit margin on a trailing 12-month basis. But then look what happens. They're so efficient that their operating margin, despite the relatively lower or low gross profit margin, is easily outperforming their industry peers, and the net profit margin pretty much in the same category there. It's doing really, really well from an operating and net profit margin point of view, despite the fact that it's underperforming from a gross margin point of view. There are a couple of ratios that you can look at as well. So I've already mentioned a few things to you, like the stochastic and the weighted alpha and the beta of the stock. Here, what we're doing is we're looking at EPD, and because it has positive earnings, we can look at the PEG ratio, the PE, the price to book, etc. Just a little summary here at the top. EPD seems expensive with a PEG value of 1.3, above the oil, gas, and consumable fuels industry median of 1. No, that's only slightly above, so that's not a worry at all. But look at this, the PE is only 13.5, and the industry median is 15. So arguably, on one hand, depending on the ratios that you're looking at, it seems as if it might be fairly priced or even expensive. But then on the other hand, it actually looks like it could be a good time to get into EPD as a potential investment. But anyway, you guys are the smart guys, so you can tell me what you think, especially if you have a position in one of these. It'd be interesting to hear what you guys have to say. EPD has a debt to capital ratio of 50, in line with the oil and gas and consumables industry norm. So it's kind of there or thereabout. You can see over here on the right-hand side, it's slightly higher than the industry average, but it's pretty much within the sort of ballpark. It's pretty much the same. Not been a significant change in debt compared to its peers. The quick ratio is not a good picture. I want to see a quick ratio of 1 or above. Now, just to kind of refresh your memory, the current ratio compares all the current assets to the current liabilities. The quick ratio compares cash to current liabilities. In other words, cash on hand, cash and equivalents, compared to accounts that have to be paid within the next 30 days or so. So the quick ratio is cash versus current debt. Current ratio takes into consideration all the current assets as a ratio to the current liabilities. However, even though the current ratio is okay, the quick ratio kind of borderline just below 1, which is not acceptable. Look at the interest coverage for the most recent quarter. It was 8.2 times. And with an operating profit of 8.2 times greater than your interest payments, you do not have any problem repaying your debt. So debt is a non-issue for EPD. So now you've got a whole bucket full of benchmarks that you can use. You can use the current market price. You can use the 52-week range. You can use the PEG ratio, the PE, which is the price earnings. You can use the quick ratio, the current ratio. You can check the interest coverage of the particular equity that you want to invest in. What I'm doing is I've given you a whole list, probably 10 different things that you can look at before you make a decision as to what it is that you want to invest in. And these are the things that you really want to make sure that you're familiar with. before you take your hard-earned cash, and put it into some kind of an equity that can make you feel very happy if it goes up, or very sad if it goes down in an instant, right? The market giveth and the market taketh away. And it will test your resolve and make sure that you have the wherewithal to make the right decision and stay in the position if that's what you have done by making the right position. As usual, guys, if you like my content, please subscribe. And I look forward to your comments, because I appreciate your comments and I appreciate the participation as we help to educate one another and build some generational wealth. So guys, on that note, this is Mr. Oxy, not talking about Oxy at all, but talking about the big pipes. Let me know what you think. I'll see you guys soon. Bye-bye.